So Nicholas Berner, Secretary of Capital, and I'd like to welcome you to one panel that I think is one of the top panels of today's forum, M&A, investing and financing opportunities in the Jones Act space. So here we cover the forum, the regulatory developments, the actual trades under the Jones Act, and now we talk about M&A, investing, the money aspect of it. And we have a terrific panel with major players in the sector. So I would like to thank you all for participating, and I will turn it over to Keith Billotti, partner from Seward and Kissel, who is going to moderate the panel. And also I'd like to acknowledge, of course, the sponsorship of RBC Capital Markets, Stifel, and Seward and Kissel. And thank you to all of you for participating.
Thank you, Nick. Thanks for having all of us here today. We have a very exciting panel for you, especially in light of the world events that are unfolding before us today. I think we'll start with a little introduction of the panel. I think we should just go around the horn. Maybe you guys can give me a little background about yourselves, how your platform interfaces with Jones Act companies, and then we'll get going on discussing M&A and investing in the Jones Act. James, should we start with you? James Berner.
Sure, thanks, Keith. And yeah, we'll have to, there's two James B's, so I'll have to names here. Just introduce myself. I'm a managing director with Blackrock's global infrastructure funds. I've been with those set of funds through two managers, but with the funds since 2011. We have evolved from primarily being an energy infrastructure investor until also now being a transportation and digital investor. And so I'm responsible for originating investments for the funds in shipping, U.S. power, or North American power, I should say, as well as LNG. So I do cover a pretty broad spectrum. The funds we're busy investing out of our third fund, which is a $5 billion committed fund. We still have $1 billion of funds left in that. And then we're looking or considering when or how to raise additional capital. So we have been looking at the shipping sector for some time. We focus on chartered opportunities, as our infrastructure name suggests. And the Jones Act certainly has been of interest because of the defensive nature of it, and it lends itself to more chartered opportunities than some foreign flag shipping. So we are evaluating a number of opportunities in the sector and develops good relationships with some of the key players.
Thanks.
We're an equity fund. Sorry, one last question. We are primarily an equity investor in the space and we're private.
Thank you. The other James B.
Sure. Jim Burchetta, Managing Director in Oaktree Capital's Transportation Infrastructure Group. I've been here about 16 years with the group in its prior iterations. We are also primarily an equity investor, but do have the ability to invest in other places in the capital stack. And have spent a lot of time in the industry. Have made a couple small investments, one larger one, and look forward to the panel here.
Great, Chris.
Yeah, sure. So I'm a managing director at Stifel. Nicholas, we're a middle market investment bank. I run the marine and energy infrastructure banking practice here. I've been doing kind of transportation and marine investment banking for my entire 20-year career, and done lots of transactions around the Jones Act, and we've seen a noticeable pickup in Jones Act activity over the last 18 months. So it's a particularly timely time to I think have this panel.
Thanks for that, Matthew. Let's jump over to you.
Great, thanks. Matt Thomson. I've been doing this for over 25 years. Did my first Jones Act deal in 1997. Have worked on dozens of M&A deals in the Jones Act since then. Echoing what Chris said, a very timely panel, given that we're all from an advisory investment banking perspective, I think seeing a big uptick in what has been a relatively small number of transactions over the years to where we are today.
And last but not least, Josh.
Thanks, Keith. Josh Shishkoff. I'm a principal here at Orion Energy. We're primarily a private credit focused platform with some equity, but broadly non-control. and our experience is energy and infrastructure broadly, usually with some energy angle that's been expanding. And our certainly not Jones Act focused or experts there, but our foray is particularly in sort of the offshore wind services side as a middle market, primarily lender in that space and otherwise.
Super. Well, the Jones Act sector is really a diversified group of companies that's all linked together by this 100-year law, old law, which requires that ships carrying merchandise between U.S. ports, need to be owned, built, staffed by U.S. citizens. So it really is a diverse sector. But with that, maybe we could start off by, providing a little overview of the current M&A market, the current access, capital markets and current access to capital that these companies have. Maybe we could start with Chris, and maybe you could focus on some sectors that you find interesting and where you're seeing some activity here.
Yeah, so I think just broadly speaking in Jones Act, and it's a bunch of different sectors, and they're all impacted by different cycles. But I think what we saw kind of broadly and around the space was, the Jones Act space overall started doing pretty well leading into COVID, and then COVID hit, and businesses, initially were negatively impacted, especially the businesses that transport energy, which is a big sector of the Jones Act business. And now we're seeing kind of a recovery in oil and energy demand since COVID. We're back up to almost the same level of oil demand in the U.S. as we were at before COVID. And you're seeing these businesses that struggled 12 months ago doing particularly well. There's a lot of owners that either before or during the struggles these businesses faced decided they were kind of non-core, or they were private equity owners, and the timing is right to exit. And there's a general kind of I think movement to consolidate the Jones Act as well. You saw Rand buy like American Steamship last year, maybe the year before. That transaction was quite successful for them. We've seen consolidation in the Hawaii and Alaska trades, and that consolidation has been quite successful. So the ability to consolidate, cut costs, and get a little bit of pricing power, is driving some consolidation. And there's a lot of unnatural owners of these businesses or private equity funds looking to opportunistically exit now that companies are doing much better. So it's really on the M&A side, I think, as Matt said, where we're seeing a lot of uptick. We're not seeing a lot of IPOs or follow-ons, and there really aren't many public companies. The most active, probably Jones Act public company was Secor, who went private last year.
Thanks for that, Chris. Matthew, do you have anything to add to that?
I would just add that you always have family businesses in the sector who are looking to transition. And when you see that, you see a lot of the consolidation. We sold the flowers business at the end of last year to Maritime Partners. And I think it's notable because it's another case of a terrific family business going to institutional capital. And I think that's been a long-term trend we've seen. We've worked on a lot of deals in there. And I think that is going to continue. And as we see that and the consolidation that surrounds that, it's one of the reasons we're very bullish over the sector as a place to invest for good, stable returns over the long term.
Thanks for that. Well, while we're talking about transactions, James, maybe you could tell us some of the transactions you've been finding most interesting, anything that you're, the types of transactions that you find most interesting in the space right now.
Keith, I imagine are you talking to me? There's two.
I'm sorry, James Berner. My apologies.
All right. So, yeah, I mean, there is, having tracked this space for probably 3 to 5 years, there is much more activity now than there has been in some time. So, as I say, we have actually pursued in the past opportunities in the barge space. Again, we haven't always been the highest payer, so we haven't actually necessarily succeeded in some of these. And we've had negotiated discussions with a number of the companies. I think, a couple areas that are obvious, we'll talk about in more detail. One is offshore wind. Because we're an investor in both the power and the shipping sides, we see both ends of this and, have a pretty active dialogue understanding where those proposed offshore wind farms on the eastern United States are. We've already seen, a vessel, installation vessel that's under construction related to one. Expect to see more. This Jones Act is a sort of a new thing for some of the European wind developers to confront and to figure out the best way to structure within it. We can expect to see great opportunities there. It's a nice mix of energy transition and Jones Act. We also were seeing opportunities in LNG fueling in some of the other regional markets. We're working on a structured investment within the space. It's definitely not public and hasn't signed yet. But so, we've got a number of opportunities that we're tracking as a fund. And we continue to see good growth going forward coming out of the pandemic in the Jones Act shipping space.
The other James B, what transactions are you guys finding most interest in?
Yeah, similar, without getting too much into individual opportunities, I think we're as an infrastructure investor looking for the types of investments where you're seeing more chartered or contracted situations, along with maybe stable underlying commodity transportation and cash flows. So, really as we look through that lens, we can kind of, have the ability to look in various places in the Jones Act. And I think we've that's kind of how we've approached the market to date. And I think, continue to look, for those types of opportunities, across the spectrum.
Josh, as a credit provider, what opportunities are you seeing, and what do you find most interesting right now?
Yeah, there's a couple areas. The past few years, we've looked at a handful of opportunities with mostly privately or family-owned businesses in barge or tug or dredging or combination thereof. In situations where they need a more creative lender, because there's lots of lenders in the space that do regular way maritime financing, and it's a mature market, like Matt and Chris have done for years. So that's one where we've looked at opportunities, although none have fully gotten over that line. And then on the other side, more recently, to what James Berner was mentioning, we recently invested with some entrepreneurs doing offshore wind services. So in our size transactions, sort of middle market, lower middle market, there's a lot of entrepreneurs doing creative things that are, bolstered by the moat that is Jones Act for servicing both the construction and then, eventually operations and maintenance phase for all these projects. And so we evaluated a handful on that end, and recently got one across the line with a company who's building crew transfer vessels for a few projects that are moving forward in the Northeast.
Super. Just to shift gears a little bit here, I kind of want to talk about what's going to drive growth in the sector. And you guys have all hit on the activity in the M&A market, so we'll kind of start there. We've all seen some significant M&A, both operating companies merging with each other and acquiring other operating companies, and also PE firms have been getting involved. Do you guys see this as a long-term trend, or is this something that's just been happening recently, or are we just starting to see the beginnings of this? Chris, maybe we'll start with you.
Yeah, so it's definitely the beginnings of a trend as opposed to the end, in my own view. But no trends last forever, especially in capital markets and banking. So I'm sure it'll come to an end. But there's definitely substantial benefits to consolidation in this space, which I think was your question, Keith, around whether the space should continue to consolidate, right?
That's exactly right.
Yeah, and so there's been a lot of consolidation, as I mentioned in my initial discussion, and it's been very successful. Customers have benefited, because they get better service, and companies have benefited because they get better backhaul, they have lower administrative expense. And the other thing we see in Jones Act is, it's extremely expensive to build vessels. Extremely, and since COVID, the cost of building a lot of these vessels has gone up 30-40% or more. I've heard companies even say certain types of assets have doubled. Like, we were talking to a Jones Act company that needed chassis this morning. The cost of a chassis has doubled since since COVID. So, the ability to replace equipment is really challenging. So you've got to utilize the equipment you've got as efficiently as possible.
Matthew, do you think consolidation should continue?
Oh, absolutely. This has been a 25-year trend. I mean, this has made my career and will I hope, allow me to continue to have another decade doing this. We still have a significant number of Jones Act companies out there. We have some very good consolidators. Obviously, everyone's familiar with Kirby if they're listening to this call. But we have a lot of other companies that are great consolidators. To Chris's point, there are significant synergies to consolidation. I think you're going to continue to see it. We've seen some of it on the lakes recently. We'll continue to see it on the rivers. And I think logically we'll see it coastwise continue as well. So I think it's just part of a very long-term trend. You can look at the rail industry and what happened there over a period of years. We probably won't have an additional big deal after Kansas City Southern. But if you draw a parallel to the rail industry with the Jones Act, we still have decades to come, or at least I certainly hope so. I won't have a lot to do.
James Burchetta, will private equity continue to have an outsized role in these consolidations? If
Yeah,
not,
I think so.
Go ahead.
From our seat, the things that are attractive about the Jones Act, barriers to entry, not only the statute, but the other barriers to entry you see, I think are not going away. They've been part of the Jones Act and the trade for 100+ years. And while they may be shifting and changing a little bit, I do think there will continue to be interest from folks on this side of the table.
James Berner, do you agree with that?
I agree, and obviously the one difference about the sector of anything else we look at is which I'm sure you'll get to is the limitations on ownership, and because anybody who's a fund is generally deemed a foreigner, even if they've got significant U.S. LPs. So that is, it's a sector that lends itself to partnering. Would be one comment.
Now should M&A in the space only contemplate pure plays, or are more diversified plays more acceptable these days? Chris, do you have a view on that?
I think it depends on, a lot of things. I think both work. I mean, you can look at companies like Crawley and C Corp, they're very diversified. They're in lots of different businesses. But then there's companies like Kirby that have remained quite focused on just, tank barges. So I think it depends. A lot of these Jones Act spaces are small. So, if you want to grow, beyond, how you can grow in your little sector, you got to expand into new sectors. But there's not necessarily a lot of synergies between sectors. So that's why I think both ways, work, and we see both strategies.
Matthew, do you have anything to add to that?
I think it's very hard to stay pure play and grow. And so where you have great operators, I think what you'll see is a continued expansion into other parts of the Jones Act. And I think you can think of the folks like Salt Chuck, which have multiple different parts of the Jones Act covered with their business. Where you have expertise, you expand. I mean, the Kirby example is a good one, but they were, pre the KC deal, really focused on the river system and not coastwise. So I think where you have very good operators, you have the ability to grow, but often only through expanding into new parts of the Jones Act. And I think we'll continue to see that because we do have some great operators out there who are looking to grow and are challenged at growth in their specific market.
James Berner, anything to add to that conversation?
No, but I think diversification can also be outside of Jones Act. So you could have a shipping company picking up maybe some rail or trucking assets or storage assets. And so, there are kind of natural adjacencies. So it does make a lot of sense.
So in these M&A transactions that you guys are seeing, how are the debt providers viewing and reacting to the transactions? Are they generally cooperative? Do they throw up some obstacles? Josh, what have you been seeing?
I mean, I can certainly speak from the non-traditional lender side of things, and sort of like I mentioned before, there's been situations where our style and our structure of capital and our partnership can be compelling, but it doesn't fit the typical cookie cutter. And so I think that's where we've played a role, particularly on the wind side. I think a lot of the traditional lenders will be there in large size over time. They've already done that to some degree, but I think as you have nascent, it's not a new market from the European perspective, but from the US, it's still nascent. Projects still need to get pushed through the approval pipeline. There's lawsuits, there's challenges, there's contracts in place, but they're not as straightforward as traditional lenders like to see. And so I think that allows us to be creative and flexible. But as that matures, I think in offshore wind specifically, that will evolve to fit more of the center of the fairway financing for traditional lenders. And that's what we've seen in competing with providers in the non-offshore, so dredging and barges and tug space. There's a lot of well-trodden paths to capitalize businesses or commensurate transactions there. So.
Super. I want to shift gears a little bit and discuss access to capital that these companies have. I mean, traditionally, there's been plenty of debt capital available for private owners. Public owners have been well capitalized. Do you guys think that this is going to continue, or do you think it'll change? Will recent events have any impact on this beyond the near term? Maybe we can go around the horn and kind of speak to that. We'll start with James Burchetta.
Yeah, look, I think again from our point of view, the capital that's been available, I think the receptivity we've seen on the things we're interested in and we're looking at from a debt perspective has been pretty robust, and would expect that to continue at least through the things we're looking at that are probably a little bit different end of the spectrum than some of the things Josh is looking at.
Matthew.
Yeah, look, I think capital is very available and will continue to be. The events of today, I think, only reinforce the need for the Jones Act and the attractiveness of a protected sector like it. We are a debt provider at RBC. We do it both off our balance sheet and through syndicated finance, as well as we've done private deals. That market will continue to be available. Certainly, Josh and others have an ability to provide debt finance through other ways, but the debt markets are still very robust. And I think we have a lot of conviction that this is Jones Act that we're talking about and not shipping. That's a line we use a lot. And Jones Act has a very different set of debt characteristics than traditional international shipping. And that allows us to access the debt markets at pretty attractive rates for a lot of deals. From an equity perspective, it is harder to access equity capital for the Jones Act due to some of the protections provided by the Jones Act. You can't just go out and find a foreign investor to do deals. There isn't a very deep public market. Clearly, we do have a couple exceptional companies that are public Jones Act companies, but by and large, most of the equity comes privately. That requires more work. It's not as easy as just going to a very liquid public market and accessing it. But the good news is there are deep pockets within the Jones Act equity market. And I think they continue to see the value in it and will continue to put capital behind it. So we're optimistic that this will remain a robust capital market, both on the debt and equity side.
Josh, do you have anything to add to that?
No, I think just one thing I'll reiterate is obviously the events of today definitely reinforcing. We came into the space certainly not being maritime or Jones Act focused investors, but sort of energy infrastructure broadly, and did a lot of homework and diligence and learning and speaking to folks around Jones Act and is there risk around that, and got very comfortable with it. And ultimately, I agree the events of today reinforce that it's a very long-standing, and the rationale being maintaining U.S. infrastructure to build out vessels. That's not going to go away anytime soon in our view, and therefore the capital will remain available.
Chris, any views on the impact of today's events and on the access of capital that these companies will have?
I've gotten a number of notes from our various desks that markets are more or less closed for new issuance, like investment grade markets closed. I would assume any equity deal that's in the market today has been pulled. It's going to wait. So I mean, there's massive volatility in the market right now. Everybody's kind of scared. It'll settle itself out, at some point, hopefully quickly. I mean, it's possible that this drags on for a long time, but hopefully it settles quickly. And everybody can get back to business. But it's definitely, having a major impact over the last, couple of weeks, and particularly today.
Now, the Jones Act, James Berner hit on this, and so did Matthew. There's a lot of barriers to entry to get into the Jones Act space. Do you guys think that it provides a competitive advantage, or is it really just an impediment to these companies growing? James Berner, maybe we could start with you.
I'd say it's both. And this will touch on adequacy of capital. So it is challenging to own 100% as a financial investor unless you're a family office in the U.S. Therefore, this is not likely to become an opposite of overbanked, an overfunded sector. The opportunities when you look at from a structured fund side, they're decent size, but they're not large. And it is very much kind of a relationship-driven sector. So I think if you invest the time in it, and I've at least invested a fair amount of time getting to know almost all the players, it's rewarding in that you do see opportunities, and they aren't a solar project where you've got an unbelievable number of people wanting to throw capital at it. So from that standpoint, I think it's attractive. As you say, the flip side is there are significant barriers in terms of how you have to invest your capital via different structures, and frankly, how much as a percentage you can own directly or indirectly. And those are a challenge. You can't, in most cases, own 100% of an opportunity if you're not a U.S. citizen. You've either got a partner or, use some of the creative techniques that that you and other Jones Act councils have pioneered. So I think that'd be my general comment.
James Burchetta.
I agree. I think there is two sides to it from our perspective. There's a real attractiveness to those barriers of entry. It does provide, a competitive advantage, and I think, the underlying rationale for the Jones Act and the way it's been set up really bolsters that, as we look going long term.
Now, Chris, do you have a view on whether the barriers are too much or whether it provides a competitive advantage? Structuring and, doing these tiering systems and putting in place warrants, has attracted a lot of foreign investment. But obviously, as James was mentioning, the amount of foreign investment has to be limited. Generally, a tiering structure can only, you have to be a little bit more than 50-50 US. Do you see these bids being obstacles, or are folks overcoming them pretty easily?
It's definitely an obstacle, particularly amongst the private equity investors who mostly are offshore and not Jones Act qualified. But we saw in the tanker space in the kind of 2013 to 2015 period, when rates went sky high and shipping black oil, they built a whole bunch of barges to move the oil. So if rates go high enough, capital is going to find a way to come in and build ships. The constraint we see now is, the cost to build those assets is literally 40-50% higher than it was, in 5 years ago. And there's very little yard capacity to build these ships. There's shipyards have shut down. And then you've got the Navy. The U.S. Navy is going from 290 ships to 360 ships. They're taking a huge amount of the yard capacity that might have otherwise been used to build Jones Act tonnage. So there's very limited ability to add new capacity, even if you wanted to.
So I think this is a good segue into talking a little bit about the investors in the space. The Jones Act has obviously been around for a long time. Has the investing base changed over that period of time, or are the same players in the market that have always been there? And we'll start with Matthew.
I think by and large it's still relatively the same business I remember from 25 years ago when we sold a barge business to a private equity fund. At the time, we looked at strategics, we looked at private equity, and the private equity beat the strategics and won the asset. When we run processes today, and we've run numerous ones over the last several years, we continue to see strong interest from private equity funds and they're often competing against the strategics. Now, some of the folks who are in charge of the strategics have changed. Some of the strategics names have changed. Some of the funds are the same. Some of the funds are different. But when we think about who's actually out there looking to invest, I think it's relatively similar. We have seen slightly more institutional capital as that mix of kind of family businesses has shrunk in the overall Jones Act. But I think what's remarkable is over the period of time, it is still a relatively similar process when we think about looking for new candidates to own a business that we saw 25 years ago.
James Burchetta, do you have a view on that?
Not a very differing view. I think that's generally right. I mean, I think there's, as we've been sort of studying the sector in detail for the past 7-8 years, there's been I think a good mix of family, institutional, and public, and I think while that will change and shift, I think it's likely to remain, relatively the same over time.
Josh?
Yeah, I mean, I think I put more weight into Matt's view than mine, but I think being a non-traditional lender, I think one of the reasons our mandate was something we started was because we saw a lack of non-traditional, more creative lending in multiple spaces, and I think that might be a small part of Jones Act, particularly in nascent markets like offshore wind and other things that are less mature and less well-trodden, where there's lots of players that will continue to be available. So that might be a slight difference today, but that's more of a capital trend that sort of is expanding to multiple sectors, parts of Jones Act included, than it is a comment on the Jones Act specifically. So.
Now, investing in the Jones Act space, presents different challenges for investors. There's significant penalties for non-compliance with the Jones Act. You could lose your cargo. There's civil fines. In certain cases, there's criminal penalties. When you guys look at an investment in the Jones Act, do you approach it any differently than you would investments in other spaces? James Berner, maybe we could start with you.
I think your lead-in led to an obvious answer, which is yes, we do treat it differently. As you said, we very much, we've looked at structured investing and sort of straight up equity investing. I'll give you an advertisement. We retain extremely well qualified, experienced Jones Act counsel up front to evaluate any structure we consider investing through, as well as what we do the process potentially to get it approved if necessary. There's also some tax considerations that are driven by it as well. So yeah, absolutely, I would say there's more structuring involved here than there might be in some sectors that don't have those protected elements.
Right. Now ESG is in high focus, especially in the shipping industry. How do you guys evaluate Jones Act companies from an ESG perspective? From an E part, it's obviously a carbon heavy industry. Ships are a little bit older, not a lot of space at yards. The other aspect is that, there's generally a lot of unions involved, maybe a little better from a social aspect. How do you guys think about ESG in the context of the Jones Act as you think about investing? And we'll start with James Burchetta on this.
Yeah, obviously critically important to our analysis. Look, one of the ways, on the E, the E of the ESG we look at is are the, how would the cargoes, you may be carrying otherwise be transported there, and what's the total overall calculation? So that's obviously a huge part. When you look at the total picture of the transportation of those goods, and look on the S side, obviously similarly important. A lot of the companies we invest in are very heavily union. We are generally pro-union and have no issue with that. We've negotiated that in the past, and think it's important that leg of the stool is taken care of also.
Chris?
Yeah, I mean, I can say we've seen like a huge rise of importance of ESG towards towards buy-side investors. So guys like, our two Jameses, a year and a half ago, I don't think it would have even come up in conversation. Now, every single deal that comes up in conversation, all the businesses that we're selling, we dedicate, several pages of the marketing materials to ESG. The ESG that's really, I guess focused on most with shipping is right now is it's the lowest carbon way to move goods around the US. I know that was mentioned before, but it's, it's literally like 40 or 50 times more efficient than a truck. It's like 25% more efficient than a rail car. We don't really have any way to make ships, not release carbon at this point. At some point down the road, there may be alternative fuels that, are carbon neutral, but for now, it's the lowest carbon way to move goods. And the more you can move on a ship, the less carbon you're going to release. So that's really how we focused on it.
Super. Well, now I know no one likes to give predictions, especially in the shipping business. So we'll talk about it in terms of trends. Maybe you guys can discuss a little bit about the supply and demand outlook going forward in some of these sectors. I know some of you hit on it that there's yard capacity issues. People need to retrofit vessels to comply with environmental regulations. Wind is coming online. Maybe you can just talk a little bit about what you see as far as supply and demand and how it's impacting various sectors in the Jones Act space. And we can start with James Berner on that.
Yeah, I think you guys touched on some of it. Obviously, now is a particularly difficult time to build anything. As we mentioned, there's never much great shipyard capacity to begin with. And then when you add in competing with the U.S. Department of Defense and the price of steel and labor going up substantially, the supply of ships should be constrained. And we're coming out of the pandemic. We've clearly seen pretty strong bounce back in a few sectors, and I think some of that will continue driving demand. Obviously, you got some tailwinds on the infrastructure side from infrastructure bill and other things. And commodity prices are going up. I'd say the one read through from today's events, because Russia doesn't really touch the Jones Act too much, but is commodities and volatility in commodity markets. So all those to me suggest, you probably, and it may be more of a near term than a long term phenomenon, will have demand growing while the supply of ships is constrained. And I think those would be, and again, I'm probably the least experienced of most of the panelists here, but those would be my headline observations.
Matthew, anything to add to that?
Yeah, I think one very important component we haven't talked about is rate. And so when you think about what's happened with the steel costs, the rate that we're seeing in the market, again, broadly across the Jones Act, so there are specific examples where it differs, but broadly speaking, the rate that we have that we're seeing the providers charging customers doesn't justify reinvestment in equipment. So what you're going to have to see is rates move up to justify the steel and the labor costs, which are now required to build new equipment. So while there are capacity constraints, there are also economic constraints. And those economic constraints are one of the major reasons we're so bullish on the value of assets today, because what you're going to see is a lack of new supply coming because the rate environment doesn't justify significant additions. And so what's going to happen logically is we are going to continue to see scrapping. We have very good scrap prices. We are going to continue to see some good demand. And what that's going to do is push the rate environment much higher so that we can get to a place where reinvestment makes sense. And so we think that logically you are going to see a very good environment for, broadly speaking, Jones Act operators over the next several years, in large part because of the steel, because of the labor component, which is going to restrict the new supply coming on.
For as long as the Jones Act has been around, people have been talking about repealing it. Does that impact in how you invest in the space, how you price assets? Josh, any views on that?
Yeah, I think maybe it'll be interesting for some folks who have been in this market in Jones Act for a while, like Matt and others, but for us at Orion being relatively new to Jones Act specific risk, this is a big question us and all of our stakeholders had in the beginning. And after talking to a lot of experts in council, we pretty quickly came to the conclusion that it's very low risk. And I'm sure there'll probably be episodic events where there's short-term waivers or otherwise so that certain growing markets don't get slowed. But in the long run, it's going to remain and going to be supportive. And Sort of on your previous question, it's a barrier to entry, it's a positive, and the impediment I think is the capital availability. But Jones Act I think is a big positive for investors in the U.S. On the side. So.
Super. Well, I think we're just about out of time here, and Chris, I'll leave it to you. Any closing thoughts?
I guess my closing thoughts would be, the Jones Act shipping space overall is still recovering from COVID. It's most companies aren't earning as much as they earned in 2019, but they're all recovering pretty quickly. I think the outlook's quite favorable. We all talked about the constraints of building new ships. Ships are getting older and need to get scrapped in this space as well. So I think it's a good time to be an investor.
Well, I just want to thank all the panelists for a very informative and insightful discussion. And Nicholas, thank you for having us here today. Always a pleasure to be at your conferences.
Thank you. Likewise. Thank you, Keith and James, Matthew, Chris, Zost, and James. It's been a great discussion. And frankly, you played such a critical role in the industry. So I'm absolutely privileged to have you on this panel, all of you. Thank you. And Keith, thank you for moderating it.
Thank you.
All the best. Thank you.
Thanks a lot.